We will now complete the income statement. I have assumed that the factor that drives the level of depreciation is the level of net long-term assets. We have already calculated the historical ratios of depreciation to net long-term assets. We use these historical ratios as a consideration when determining the forecast ratios over the detailed forecast period. I estimated that the level of depreciation over the detailed forecast period will be 4.5% of the net long-term asset balance for each forecast year. I also need to forecast the depreciation figures over the simplified forecast period. Remember, because our simplified forecast period is 6 to 10 years in the future from the valuation date, we're essentially engaged in guesswork. Therefore, we need to keep it simple and only forecast the bare minimum number of line items to calculate free cash flow. But the approach we're using to calculate free cash flow requires separate depreciation figures over the entire forecast period. We're deriving measures for free cash flow to the firm and free cash flow to equity using a particular approach where we forecast the income statement and balance sheet and extract the free cash flow figures from these forecast financial statements. But the free cash flow measures represent cash flows, whereas the income statement and balance sheet are prepared on an accrual basis. Therefore, we have to occasionally adjust or reverse non-cash items. Depreciation is an example of a non-cash item that has to be adjusted for. To calculate free cash flow to the firm, we want to figure out the cash spent on capital expenditure during that particular year, or the CapEx. The way we do this within the model is we forecast net long-term assets in the balance sheet, and we calculate the change between net long-term asset balances year on year. This change between the net long-term asset balances represents the capital expenditure for a particular year. But the net long-term asset balances are accrual figures from the balance sheet. Each year, these balances are reduced by a non-cash item, depreciation. Therefore, the change in the net long-term asset balances between years, or the CapEx, has been reduced by the depreciation recognized in that year. We therefore have to top up or increase CapEx by the depreciation figure to get an estimate of the gross amount of cash spent on capital expenditure. Let's forecast the depreciation figures. I need to fill in the forecast ratios over the simplified forecast period. I will assume the ratio of depreciation to net long-term assets remains at 4.5% over the entire forecast period. To calculate the forecast values for depreciation, I apply the forecast ratio to the driver, which in this case is the net long-term asset balance. We need to forecast EBIT over the simplified forecast period. We need the EBIT figures over the entire forecast period because they will be used to calculate free cash flow to the firm. To calculate free cash flow to the firm, we begin with EBIT multiplied by 1 less the effective tax rate. Because we haven't forecast some of the line items that EBIT is comprised of over the simplified forecast period, we will have to derive EBIT using forecast ratios. Firstly, I will assume that an appropriate driver for EBIT is sales revenue. I will now calculate the historical ratios of EBIT to sales revenue. I will then estimate the forecast ratios over the simplified forecast period. I'm going to assume that Tesscow becomes slightly more efficient at managing their costs and set forecast ratios of 6.5% over the simplified forecast period. To calculate the EBIT values over the simplified forecast period, I apply the forecast ratio to the driver, which is sales revenue, I previously explained that we will use opening net debt as a driver of net interest. We've already calculated the historical ratios of net interest to opening net debt. We've also estimated the forecast ratios. I assumed the forecast ratios would remain constant at 3% over the forecast period. All that's left is to calculate the monetary values for net interest in the forecast income statement. To do this, I multiply the forecast ratio by the driver, which is opening net debt in this case. Next, I need to forecast the effective tax rate for Tesscow. I need the estimates of the future effective tax rate to calculate the interest tax shield and NOPAT, which is EBIT multiplied by 1 less the effective tax rate. To forecast the effective tax rate, I first calculate the historical ratios of tax expense to earnings before taxation. I can use the historical ratios as an input when estimating the effective tax rate over the forecast period. I'm going to assume that the effective corporate tax rate remains at a constant 24% over the forecast period. Interest tax shield represents the tax saving from being able to deduct interest payments in the company's corporation tax computation. The amount of the tax saving is calculated by multiplying the deduction, that is net interest expense, by the effective tax rate. Remember, one advantage that debt has over equity as a source of finance is it is cheaper. It is cheaper because interest payments can be deducted in the corporation tax computation. This results in a financial benefit for the company because it lowers taxable profit, and therefore the company pays a lower sum over to the taxman for that taxable period. In contrast, dividend payments to shareholders are not tax deductible, and there is no associated tax saving for the company. We need to estimate the tax savings, that is, the interest tax shield, over the forecast period because it is a component of after-tax net interest. After-tax net interest is the net interest expense after removing the tax saving on the interest payments. We need to estimate after-tax net interest to move from NOPAT to net income. Remember, NOPAT is used to calculate free cash flow to the firm. It reflects the cash earnings available to all capital providers, both debt and equity. It represents the company's potential cash earnings if it were unleveraged. In other words, the measure is not influenced by the company's capital structure and its use of debt. On the other hand, net income is used to calculate free cash flow to equity. It reflects the earnings that belong only to equity providers. Net income is affected by the company's capital structure and its use of debt. It incorporates the debt holder's claim against the profits of the company, that is, net interest, and also the tax saving to the company from being able to deduct the interest in the corporation tax computation. that is, the interest tax shield. Let's go ahead and forecast the interest tax shield. To forecast the figures for the interest tax shield, we multiply net interest expense by the forecast effective tax rate. We can now calculate after-tax net interest. After-tax net interest is the net interest expense excluding the tax saving from the interest payment deductions in the tax computation. In other words, excluding the interest tax shield. NOPAT equals EBIT multiplied by 1 less the effective tax rate. Remember, we have stored our forecast effective tax rates as negative figures. Therefore, we can forecast NOPAT by multiplying our forecast EBIT figures by 1 plus our negative forecast effective tax rate. Finally, to derive the forecast net income figures, we will subtract after-tax net interest from NOPAT. We have now finished forecasting the income statement and balance sheet for Tesscow over our selected forecast period. We will use these forecast financial statements to extract the measures of free cash flow to the firm and free cash flow to equity that we need to perform the valuation. Next, we will reorganize the information in these forecast financial statements in order to more easily extract the components needed to calculate the free cash flow measures. We will do this in the Reorganized Financial Statements tab.